What's going on, traders? Welcome to another video. This one is going to be about the point of interest and trading. Where do your high probability and high time frame trade forms? So first start with the introduction. A point of interest is the important part of your strategy. This is the area where your high probability and your high time frame trade forms. Without knowing the high time frame bias and a defined feed area, you are just trading patterns. You are looking for lower time frame patterns. You have to have the high time frame point of interest. So we will go over some of the important point of interest in this video. Where is your trade forming under reversal days? Under reversal days, you are trading away from the low of the day, which is after confirmation of the daily profile, or you are trading when the high time frame wick is printed. And on the continuation days, you are trading within the 50% of the previous day's range, especially in the nearest quadrant. If bullish, we want to see the wick of the candle forms lower, and if we are bearish, we want to see the wick of the candles forms higher and then continuation lower. Now the point of interest for the market maker models, the first one is the high time frame fair value gap. This is far more important in the high probable one. You have to wait for a fair value gap within your desired session, within your desired window, after the low of the day and the profile is confirmed, and you have to trade the swing point inside that fair value gap and assess it on the lower time frames. Here is the schematic. We are trading away from the low of the day. We trade higher, and the newer session when the 6 a.m. candles opens up, it created its low first inside an hourly fair value gap or the internal range liquidity. So our drawn liquidity becomes this high and the daily highs. And also when the price meets this fair value gap, the market maker buy model is activated. You can assess that on a lower time frame. For example, here is the 5-minute. When the price meets that high time frame fair value gap with SMT divergence, we had a change in state of delivery, which is our first low risk buy, or you can trade the continuation order blocks. Now the second one is the continuation purges, which is pairing buy stops and sell stops. This is one of the strongest point of interest in the market maker buy model. You are pairing the sell stops with the buy stops, and in the market maker sell model, you are pairing the buy stops with the sell stop. The continuation purges can show up as session highs, previous day highs, previous day lows, data highs, data lows, and often it occurs inside a high time frame fair value gap. Here are the schematics. We are trading away from the high of the day. Now we don't have any PDRA, a point of interest, to trade away from, so we had a run on the buy stops, then a swing point formation at the buy stops, and then trading towards the sell stop. This is also a kind of market maker model. On the lower time frame, it will look like this. We have reached the buy stops, purged that, uses the point of interest. For example, this is the London high or something. Then we close below the consecutive series of close candles, and then we are trading the continuation lower towards the low resistance liquidity runs and the sell stops. Now the third one becomes the stand alone swing point, which I don't recommend to you guys. This is when a swing point forms without any PDRA, but it can happen in a moment like news events, equities opens. The fourth point of interest is the range high to range low or range low to range high. When the price is stuck in a tight range, it won't reverse from the middle. The only point of interest becomes the range high or the range low. The price has to take either side of the range to then continue to the other side. And think of accumulation, manipulation, and distribution. Price must manipulate either side of the range before continuing to the one side. So the example would be this. We are in a confined range, a consolidation. This is the range low and this is the range high. Price cannot reverse from consolidation, and if it does, it will be a manipulation, consolidation, manipulation to the range low, and then targeting the range high. And on the lower time frame, the same pattern applies. You have to wait for the swing formation on the lower time frames, change in state of delivery, trading the current candle or the continuation candle. Fifth one become the order block or change in state of delivery retest. This is same as the fair value gap when your high time frame swing point forms within an order block, or a change in state of delivery is retested and a swing point is formed inside that. So that was the last one. Now which one are my favorite? My favorite one is the high time frame fair value gap with SMT divergence. because this is like the most high probability one. Now we will go over some examples using each point of interest to trade the market. Now starting with our first example, we are on the crude oil daily chart on the Monday. We have created the low of the week inside this fair value gap. Now using this fair value gap context, we can say that our price is bullish and we would target the previous day high or the Thursday high, the external range liquidity. So dropping down to the 1 hour time frame. Here on the 1 hour time frame, you can see we are above the 50% of the previous day's wick. We close above the consecutive series of down close candles, which is a change in straight up delivery. So for the next day, our bias going into the day is bullish. So I'm trading the New York session. We will skip to the New York session. Now we can use this fair value gap or the internal range liquidity as a point of interest to then trade to these highs or the external range high. Using this fair value gap as a support for the price action to go higher. And also there is S&P divergence, which you would want to see inside the fair value gap to make the reversal high probability. The RB is not taking this kind of slow, and the crude oil is taking this low and creating SMT divergence. Drop down to the 5-minute time frame to trade that market maker buy model. Now on the 5-minute time frame, you can see we have that hourly fair value gap, SMT divergence inside that, down close candles taking these short-term lows and then followed by a closure above, which is the change in the state of delivery. So we can put our limit over here, stop loss below the body lows, and targeting this range high or the range high on the daily time frame. Price takes M and then continue to the external range high. Now for the second example, we are on the gold hourly chart. As you can see, we have SMT divergence at this swing point. The gold is weaker, is not taking this high, and while the silver is stronger asset and it is taking that high. So this is our first confluence for bearishness. To the New York session, the silver takes this fair value gap, created SMT divergence inside this, while the gold is weaker and it is creating that bearish SMT divergence. Target becomes these equal lows, low resistance liquidity run, and buy side of the curve in the market maker sell model. And we can target the same for the gold. So targeting this low, this external range low right here. And one thing more, as you can see, we are in sell program, but we don't have any PDRA, a fair value gap. So we are pairing the buy stops with the sell stops right here, which is the continuation purge in the market maker sell model, pairing the buy stops with the sell stop lower. So now we will drop down to the 5-minute time frame. Now on the 5-minute time frame, we have purged those buy stops. We have a short-term high, a run on that, consecutive series of up close candles followed by a closure below, which is the change in the state of delivery. So all of our narrative and our confluences are aligning. Now I will enter on the next candle, my stop loss above the body highs and targeting the external range low are the sell stops, and the price expanded towards the external range low and the sell stop. Now for the next example, we are on the NQ daily chart. We are in consolidation where we have reached the range low. The next target becomes the range high, and we are also reacting up the range low, down close candle followed by closure above, which is a continuation signature. Keeping that idea in mind, our higher time frame bias is bullish. Now dropping down to the 1 hour chart. Now here on the 1 hour chart, you can clearly see this is the original consolidation, the sell side of the curve, a reversal taking place at the range low, a V-shaped recovery, and now we are trading bullish with a market maker buy model. On the Thursday candle, we took the previous day low and tapped into this new day opening gap. So this become our next range low, and this is our range high. The price is fractal. So now we have reached the range low. We need a closure above the consecutive series of down close candles to then trade it to the upside. Now with this candle, we have closed above the consecutive series of down close candles at the range low, which is the change in state of delivery, and it is telling us the range low has been manipulated, and now we are trading to the upside. And going into the New York session, we expanded to the upside, completing our market maker buy model, a range low to the range high in a bullish program. So this was the next example of pairing the sell stops with the buy stops. We can also fractalize that concept and trade it on the lower time frame. So on the right side, I have the YM, which is taking the 8am low, and the NQ is not taking that low, which is creating SMT divergence. And these are the times when you are using the order block at the point of interest. We had a down close candles followed by closure above, change in state of delivery, then an order block tapping into that, and now closing above this, and now using it as a support once again. So these are the times when we use an order block at the point of interest. I will drop down to the 5-minute chart to trade the market maker buy model. Now on the 5-minute time frame with this specific candle, we have taken this short-term low and the previous candle low on the YM, and we have created SMT divergence on the NQ, closure above the down close candle that is creating that SMT divergence, entry on the next candle, stop loss below the SMT low or giving it a little bit room because we have a large target, and the price expanded to the range high. The fair value gap and SMT divergence at the Tega fair value gap, I have learned this from the sniper trade, Sumit Luber. Many of you will know him. This is the high probability and the most probable PDRA to trade the market maker model from, and 70% of the time when your high time frame bias and order flow is right, this will work. Thank you guys for watching. Make sure to subscribe to the channel and like the video, and see you in the next one.